Good afternoon, everyone, and welcome to the fourth of what may prove to be at least four webinars for Tax Insider. This one entitled How to Get Value Out of Your Company Tax Efficiently, Thursday, 27th of May, 2021. Now, about this webinar, by now you'll all know that it's a tax-centric talk. This month is to cover the sustained manipulation of OMB company taxation. I want to really go into two key topics here, which is incorporation still going to be worth it from April 2023 when corporation tax rates are set to increase quite significantly? The perennial question of salary versus dividend, which is better, and newsflash, it's not as simple as it used to be. Useful benefits in kind. This is more of the sense that it isn't always about cash. There are lots of things that your company can do for you that can get you value. And then taking that value question to more long-term stuff like loans to directors, putting your family to work, and long-term planning. We do have a lot of slides to get to, so I'm not going to linger on anything for too long. Okay, having said that, I'm about to take you back in time roughly a decade. It's not the last emergency budget, but the last emergency budget, courtesy of gorgeous George Osborne, wherein he said, our corporation tax rates are looking less and less competitive. So the main rate of corporation tax is to be reduced by 1% per annum from the current 28% down to 24% by 2014. It's fair to say that George got a bit carried away over the next few budgets and reduced the main corporation tax rates yet further. But quick question, did your average family company, owner-managed business company, paying corporation tax at the small companies rate get to enjoy any of this reduction? Well, I wouldn't be asking if they did. But fast forward about 5 years to July 2015. So we're only looking back now about 5-6 years from today, still filling out that history, still with gorgeous George. July 2015 summer budget, the main rate of corporation tax has gone from 28% in a few years down to 20%, and it's now aligned with the corporation tax rate for smaller companies. So that's nice and simple. However, George is beginning to panic. Says to himself, to keep up this generosity for multinationals, we need to start squeezing UK individuals for more income tax on their dividends. He didn't say that, of course, didn't actually say that in public. What he actually said is, we can't take it lower than that while such strong incentives are created for people to self-incorporate and pay the lower rate of tax due on dividends. And I want to sort of pause for a second and just make the point that in general terms, large companies or small companies paying dividends to other large companies, as in multinationals, cross-border, out of the UK, whatever, generally do not pay income tax on their dividends or suffer corporation tax for doing so. Likewise, non-resident individuals don't pay income tax or any more income tax than has been withheld at source from their dividend income. So really, the only group left to pay income tax on dividends are UK resident individuals. So what did he do? He introduced a £5,000 zero rate allowance, then a basic ordinary rate for dividends at 7.5%, up until the high rate threshold, which in today's money is around 50,000. Above that, 32.5% on dividends, and over £150,000 of the taxable income, it rises 38.1%. Bear in mind that at the beginning of that Parliament, he promised that there would be no further income tax or no income tax rise on income. Income tax rise on income. No rise in income tax. And yet we had a rise in income tax nonetheless. All this just to cover the cost of reducing the corporation tax rate for all companies, including multinationals, from 20% down to 19%. And if you think that's bad, the £5,000 zero rate allowance only lasted for about 18 months before George's successor decided that was way too generous and had to be slashed down to just £2,000. So what does this all mean? Well, I've tried to convey this visually, if not graphically, with a simple chart which compares the income tax cost for rising personal dividend income. And I'm comparing the amount of income tax that it cost in the last year before these rates all changed. That's the orange line, with the first year in which the new dividend regime was introduced, which is 2016-17. And if you look along the bottom, you will see that at first it doesn't make that much of a difference, but let's just say that by £40,000 of dividend income, you would have paid under 500 quid in 2015-16, but by 16-17, you'd have owed nearly 2,000. And it gets worse as the difference between the two lines, the two charts, increases as incomes rise. And what you have is a situation where by the time you get to 120, 130,000 upwards, you're seeing a £10,000 margin in difference between the income tax that you used to pay and the income tax as a UK individual you now have to suffer. So definitely worse off UK individuals as a result of George's generosity to very large companies and multinationals. So post-pandemic, bringing us right up to date now, this is Dishy Rishi having a go. The government has provided business with over £100 billion worth of support to get through this pandemic, so it is fair and necessary to ask them to contribute to our recovery. So I am going to raise the rate of corporation tax from April 2023 to 25%. So that's increasing from 19% today to 25% in a couple of years' time. Won't take effect straight away. Everybody will have recovered economically by 2023, no doubt. And I'm going to protect small business with the profits of 50,000 or less by creating a kind of safe harbour. Profits of up to 50,000 will still be taxed at 19%. Now, what he didn't say was that this complete reversal of the last 10 years worth of consecutive government policy regarding corporation tax was going to be balanced by cutting dividend taxes back to how they used to be. I'm sure he'll get around to mentioning that one day. The other thing that I'd mention is that first £50,000 at 19%, which is currently to protect people, that's crying out for what consecutive governments have called simplification, which to you or me just means getting rid of something which used to save us tax. So it's a quick question again. Did OMB companies actually get £100 billion worth of support or anything like that during the pandemic? Or was a very substantial proportion of that actually aimed at their employees? The coronavirus job retention scheme, so far as I know, is by far and away the most expensive of the measures that the Chancellor has adopted over the last 12 months. But the point there is that it's actually helped employees. And by contrast, it's helped shareholder directors. Typically, OMB shareholder directors very little. They tend to take quite modest salaries. So the coronavirus job retention scheme will have helped them only modestly. The only other sort of substantial support that was out there, really, certainly in terms of income rather than loans, is the small business support grants. They were substantial, but not small, but I don't think they came to 100 billion. So having set the scene, I want to just quickly look at the question of incorporation. And this chart is intended to illustrate the net yield or the net benefits of incorporating. If we take a single self-employed individual, trading individual, and he or she incorporates his business, then takes a modest salary of roughly £9,000, and all of the dividends after corporation tax, he or she then takes those in the year in question. What you find is that pretty consistently, after the first sort of few thousand pounds of profit, whatever level of profit, it's better to be incorporated. It's better to be incorporated than it is to be self-employed. And that was nice and straightforward. If we look now at where we are today, the green chart, the blue chart obviously showing how it used to be in 2015-16, the good old days. Same comparison, single sole trader contemplating incorporation today. It's a bit more complicated, it's a little bit more bumpy, the graph, but you can see that around £150,000 worth of profits and onwards, there's no saving at all. And soon after 200k, it plummets quite badly. The other thing that I would point out is that this model assumed there is no extra cost of incorporating a business. And that obviously is a simplification, arguably too far. It can easily cost you an extra £1,000 a year to run your business through a limited company. So it's a mathematical comparison, but in actual fact, these charts could easily shift south, shift downwards by £1,000, and that would show that these so-called net benefits of incorporating is actually much narrower than these current figures or lines suggest. Let's fast forward to 2023. Not too bad so far, manageable maybe. Well, now, looking at the figures for sort of the individual contemplating incorporation from April 2023 onwards, now I've got an orange chart here. So we have in the background there the faint blue, pale blue dotted line showing where we used to be in the good old days, sort of 2015, 16 and beforehand. Where we are right now, or 22, 23, just before these new corporation tax rates come in, it's looking significantly thinner. But by April 2023, or from April 2023, we're kind of heading pretty rapidly south, but anything above 60, 70,000 pounds. And by the time you get to roughly 200,000 pounds, it's really quite catastrophically bad. I would like to sort of take you back in time just momentarily to roughly 2017, and Phil Hammond at the time was absolutely distraught about how people were undertaking tax-motivated incorporations. This terrible problem that the Treasury's coffers were having with self-employed individuals incorporating and saving themselves potentially a couple of £1,000s worth of tax in HMRC's estimation at least. So if we compare this graph, just have a quick look at the sort of far right-hand side. The Chancellor was sort of 4 or 5 years ago was getting really worried about the fact that a company making 300 grand's worth of profits could save potentially up to £10,000 worth of tax. That's not an insignificant amount. But if we look at 2023, what's going to happen in 2023, that same company now stands to lose £15,000 worth of tax. And yet, the Treasury doesn't seem at all bothered about that lack of symmetry. You can't imagine why. So, looking forward to a couple of years, should I incorporate? We can summarize what we've seen over the last sort of 3 charts by saying that a singleton 100% shareholder director will be largely unaffected where profits of 50,000 or below. Might save a little bit of money, might cost him a little bit, arguably not really worth it once you factor in the actual additional costs of running a company. But above sort of £70,000, it starts to take a significant turn for the worse. And by 100k of profits, incorporation is almost certainly worse than staying self-employed. Now, you might say, well, why are you pointing out profits of £80,000, £100,000, £150,000, £300,000? You know, my owner-managed business is nowhere near that. Well, the reason why is because it's much, much worse if you're not a sole trader and you're in partnership, or you're running a business jointly between spouses or civil partners. So the figures in the charts are for a sole trader. And as I say, you know, you might save mathematically at least £2,000 or thereabouts, a profit of 55,000. But if you own more than one company, or if you're in a partnership, it gets much worse, much faster. Effectively, the graph gets a bit scrunched up, and you would find, for example, I think the numbers are, I'll give you some of the numbers later on, but you will find that you'll start to lose out through incorporation at much lower levels of profit. So a quick look at landlords, because so far we've been looking at sole traders who are self-employed. And one of the key points about sole traders is that they suffer self-employed national insurance contributions, whereas landlords don't. And in this chart, I'm briefly going to touch on the situation for landlords of residential properties who were victim to that other abomination that Gorgeous George foisted on us all in the summer 2015 budget, which was the interest restriction for residential finance costs, mortgage interest on residential lettings, buy-to-let properties. Now, up to 2016-17, when before that measure was introduced progressively over the next several years, arguably from an annual income tax perspective, there wasn't much point in incorporating. There might have been other reasons to incorporate, but certainly in terms of the income tax net saving that a singleton landlord or landlady might enjoy, there wasn't really anything to be had. That changed quite significantly because of how punitive the measures were for restricting interest costs from a tax perspective. In this graph here, the 2015-16 situation or thereabouts is shown by the pale blue dotted line. Where we are today is the dashed darker blue line, and that shows that there is an advantage to be had in incorporating a residential letting business. That advantage is cut, certainly, from 2023-24 onwards as corporation tax rates are increased and start to bite more heavily. But the critical factor here is that this is in the example that I've done here, this is a quite highly geared property business, which is paying 50% of its rental profits in mortgage interest, roughly a third of the gross income. So the general rule of thumb would be that the less highly geared you are, the less interest that you're paying, the better off you would be by not incorporating. It's really only if the sort of mortgage interest costs are pretty substantial that you need to start worrying about whether incorporation is the right step to take. Now, I don't expect to memorize this slide or necessarily be able to follow it, but the reason why it's up there is that the sort of second major question I wanted to sort of pose for consideration was the sort of eternal question. I now own a company, or I'm in a company already, which is more tax efficient. Should I take a bonus or should I take a dividend? And let's assume, for the sake of argument, that I'm already taking a modest salary of roughly £10,000 a year. And this is the question: do I top up my reward package from the company in the form of dividends, or do I do it by taking further salary? Now, in the good old days, and right now, where the corporation tax rates are consistently 19%, the rule of thumb is that it doesn't matter really. Dividends are almost always better than salary. Not necessarily better than incorporation, as you've already seen, but certainly once you're in a company, dividends are almost certainly better. And we're obviously making an assumption here because it gets more complicated if there are several shareholders, or if there is a more complex mixture of rewards involving company cars or beneficial loans or mobile phones and that kind of stuff. But that simple rule of thumb has stood the test of time for quite a while. When we get to 2023-24, however, it becomes much more complicated and more patchy. The answer isn't always a solid yes. So while company profits are up to £50,000 and we're still in that safe harbour 19%, dividends will remain better than bonus as an alternative once you've had your sort of modest salary of roughly £10,000 a year. The margin narrows at higher tax rates. As your personal income tax rate increases, that margin narrows. However, there is a quite nasty marginal rate of corporation tax for profits between 50,000, company profits between 50,000 and 250k. That marginal rate is 26.5%. And in that band, it is significantly more expensive, corporation tax-wise, to pay a dividend, because the dividend is paid after corporation tax, whereas a salary or a bonus saves corporation tax. So by paying a bonus or paying salary, the company is saving a lot of corporation tax and therefore can afford to pay a higher or larger bonus. And when you are in the marginal rate, there is a reasonably substantial benefit actually to paying a bonus as opposed to a dividend, where the director shareholder is a higher rate taxpayer or an additional rate taxpayer. Still okay if he's only or she is only a basic rate taxpayer, because the dividend rate is only 7.5%. So overall, it still works out in his or her favour to take a dividend instead. When we move on to the main rate of corporation tax above profits of 250k and it settles at 25%, that margin for a higher and additional rate income taxpayers taking dividends is still there, but it's much narrower. Basically because the cost of taking dividends is effectively reduced. So I want to move on now to benefits in kind. Let's put cash and dividends and salary to one side, and let's look at what else your company can do for you in a tax efficient manner. So there are still a lot of useful company perks or benefits in kind for directors and shareholders and other employees. If you have a company, an OMB company that has a number of employees, then there are benefits that can be provided that are relatively efficient to everyone. The report actually goes into a bit more detail on all of these, a bit more comprehensive, to be fair. And I just want to skip quite lightly over these, just to give you a flavour, probably a reminder to many of you in some cases, or some of these benefits you'll be aware of their utility, if you will. Now, mobile telephone is probably the most common benefit in kind that a company provides. And for each employee or director, there's no taxable benefits in kind whatever the level of private use. But the thing you must bear in mind is that the contract must be between the company as the employer and with the mobile phone provider. If it's a personal contract, it is a benefit in kind. You're going to end up with a tax charge and potentially even an NIC charge as well. So it must be a contract between the company, the employer, and the mobile phone provider. The exemption now applies for only one phone. A few years ago, you used to have one director and you could have several mobile phones, one for each family member. That's gone now. It's one mobile phone per employee but that doesn't stop each family member who is an employee or director from having a single mobile phone provided by the employer. This is sort of a pandemic specific thing, the use of home and home office equipment. Now, the employer for a while has been able to provide, to reimburse an employee for working from home under home working arrangements. It used to be £4 per week. It's gone up over the last couple of years to £6 per week. So effectively £300 a year to cover the additional costs of working from home. In the pandemic, HMRC or the government has said that where you're not reimbursed by your company, you can still make a personal tax claim for an equivalent amount. And effectively say to HMRC, I've personally suffered £6 a week or 300 quid over the year in additional costs, and I want tax relief for that. And in fact, in either scenario, you can use larger numbers with documentary evidence to prove that the additional cost was incurred. It's worth pointing out that, in my opinion, option one is better anyway, because with option one, the company pays 300 quid, it gets tax relief for 300 quid, and the employee gets 300 quid tax free. Under option two, you're talking about a tax claim for £300 at maybe 20% or maybe 40%. So that's going to be 60 quid or £100 worth of tax relief claim from HMRC. The other thing, or the other sort of area that I want to look at quickly, is this idea that the employer can provide office equipment for you to work from home tax free. The key point here is not really how much private use there is, it's whether or not it's needed for work. Again, that's always been around, but for 2021 and 21-22, while you're forced to work from home, you can buy office equipment and the company can reimburse you tax-free for you and also deductible for the company, but you still own the office equipment. So we're talking about laptops, printers, desks, that kind of thing. It's worth pointing out that HMRC doesn't like the easement, the pandemic easement for option two, and it really doesn't like the easement for option four. So it's kind of snuck in a couple of rules that are almost certain to catch people out. It has to be prior agreements. If you want to go out and buy a new laptop, you have to agree with your company beforehand. And most importantly, the agreement, the offer, must be made to all employees on a similar basis. Now, that won't matter if you're a one-man band company or a couple of directors and shareholders, but it is going to catch out sort of larger, medium-sized companies which actually have other employees, and the directors do this reimbursement thing with laptops and what have you. But then HMRC comes along and checks: did you make similar offer to other employees who had similar needs? And the answer may well be no, in which case it will no longer be a tax-free provision. Now, employer pension contributions, this is really vanilla stuff, and I have to emphasize that you do need to take independent finance advice when you talk about pensions. Again, employer pension contributions made on an employee's behalf can be very tax efficient. There's no pay-as-you-earn national insurance. It's not a taxable benefit in kind for the employee, and it's usually deductible for the company. The employer is nonetheless bound by the rules for an individual's annual allowance. That is that, generally speaking, an individual can contribute up to £40,000 towards his or her pension a year. That you can roll up unused relief in from the previous 3 years. It starts at £40,000. If you're a very high earner, earning roughly £240,000, it does start to get tapered. You might not think that that's going to apply, but actually there are lots of medical practitioners who do find, or used to find, that the annual allowance quite problematic because of the way their NHS pensions work or used to work in this context. Now, in terms of the employer getting tax relief for the contribution that's been made, it used to be statutory. HMRC had no choice but to give it to you. The tax relief from the company would enjoy tax relief for basically any pension of any amount, there are requirements to spread very, very large contributions of roughly 500,000, where it changes from one year to the next by sort of 500k or more. The rules have changed a little bit since 2006, and now HMRC has a shout, but basically that will fall on a scenario where a member of family is, a spouse or adult child or whatever, is doing admin work and drawing, let's say, a very modest salary, but getting a £50,000 pension contribution every year. The only other factor to sort of bear in mind is how long you might have to wait to get the benefit of the pension. If you're a long way from retiring, then an employer pension contribution is not going to seem all that appealing. Again, this is a fairly well-known benefit in kind. I've lumped all these together: mileage, traveling, meals, and overnight expenses. I'd be astonished if the vast majority of you didn't know that business mileage undertaken in your own car, you can claim the cost 45 pence per business mile, first 10,000 business miles in a tax year, then 25p per mile for anything above that. Traveling costs for business purposes, again, parking, rail fare, airfare, road tolls, hotel bills, food, drink, meals, overnight stay. These can, depending on the kind of work that you're doing, these can all stack up. Something that's perhaps less well known is the idea of free or subsidised reasonable meals taken at the employer's premises or a canteen. But in OMB sort of circumstances, you'd be concentrating on employers' premises. I think the only thing you need to look out for there is salary sacrifice arrangements, that they don't trip you up. And I'll talk about salary sacrifice a little bit later on. If you, and in particular, it doesn't matter how much that you do, but the point that I'm trying to make is if a lot of people in your business, in your company, do a lot of traveling and are away from their regular place of work for hours at a time, sort of several days a week, or weeks at a time, etc., then you really should be checking out the published benchmark rates. And these are a kind of round sum allowance. Not right to use that phrase, but effectively it's if somebody is working away from home for long enough working away from their regular place of work, so on call or on a building site or whatever, away from the office, then if they're away for long enough, first 5 hours it's £5. If it's up to 10 hours, it's over 10 hours rather, it's £10. If it's more than 15, which tends to be an overnight thing, then it's £25. Now this is to cover the cost of meals taken away from your normal place of work. The cost of overnight accommodation is separate, so this sort of £5, £10, £25 is on top. If your actual cost of sort of taking meals is higher, and you can demonstrate that statistically that's the case, then you can agree higher rates with HMRC. And it's quite common, for instance, people operating out of or into cities will agree higher rates with HMRC. Accommodations on top. This is money to sort of cover meals, plus a £5 overnight incidental, which can be paid cash, NI and tax-free, still deductible for the employer, of course. £10 per night if abroad. So staff Christmas parties or dues, no taxable benefit in kind where the cost of provision does not exceed £150. Now that £150 is per attendee, not per employee. So invite your spouses and partners, it's all good. That £150 per annum limit can cover several cheaper events in the tax year. But if you break the threshold, then at least one of the events will end up being wholly taxable. The thing to bear in mind, absolutely keep on top of, is that they must be annual events. So Christmas, obviously, but if you decide to do a staff day at the races, then you're going to have to do it every year to make sure that that they're covered by this exemption for annual dues. The only other thing to mention is that Santa HMRC agreed that virtual or remote events may qualify, and that was obviously to sort of manage staff dues over the Christmas period. Trivial benefits from 2016, the rules changed. Now, I used to have quite a bit of fun agreeing with HMRC what actually constitutes a trivial benefit up until 2016, and then it all fell a bit flat under the new rules. The idea is that the employer can provide up to £50 per employee on average per occasion of benefit, and they're kind of a bit like the annual staff do. That there can be several in such events in a year. Not cash or vouchers redeemable for cash, and the employee cannot be contractually entitled to the benefit. Otherwise, it's just a taxable benefit. When it comes to closed company directors and shareholders, the maximum you can enjoy is £300 worth of trivial benefits over the year. So that's not to be sniffed at. It can't be for anything in particular. So it can't be for a specific period of overtime or hitting a sales target or something like that. And there's something quite nasty lurking in HMRC's guidance, because they really don't like this idea of having several trivial benefits periodically during the year. They are trying to link together frequent or recurring benefits. So that, for instance, if it's the provision of something that's equivalent to the cost of the employer, so £20 a month for 4 months, that's not 4 trivial benefits. Oh no, that's an £80 benefit, i.e. 4 lots of 20 quid, and you've breached the trivial benefit threshold. Now, this is very arguable, but it is certainly good or important to know the direction of travel as far as HMRC is concerned. Now, life insurance for director shareholders, for ordinary employees, for non-director shareholders, death in service is generally okay at a modest rate of return. But for director shareholders, it's always been a bit more complicated by this perceived risk benefit of when a claim arises, the company suddenly becomes worth, because of all the cash in its bank account, a lot more than it used to be. And that means that there's a benefit to the shareholders. So it's not deductible for tax purposes, or it's a taxable benefit in kind, depending on the circumstances. I want to draw your attention to a specific type of policy. Again, I'm not a financial advisor, so you would need to get your own specific guidance on this, but relevant life policies can really tick the boxes for some people. So they won't be a taxable benefit kind, but they may still get CT relief for the employing company. Now, putting to one side all the specific benefits in kind that I have done over the last few slides, I just want to look at a scenario, and this is to illustrate, or try and illustrate, that benefits in kind are actually a little bit more tax efficient overall than straight cash. So I'm going to give you an example. Dom is a higher rate taxpayer, paying tax at 40%, and he wants to spend £100 a month on private medical insurance. So he can either pay himself a slightly higher salary every month so that he gets 100 quid net in his hand, which he then spends on a private contract for medical insurance, or his company can contract directly with the insurer and provide an equivalent level of cover, let's say at the same price. And that would be a benefit in kind. There's no question there. Let's assume that Dom's company is making profits a little higher than 50k. So he's in that bad zone, that 26.5% rate of corporation tax band between 50,000 and 250,000. Now, I'm not expecting you to be able to follow this in the roughly 30 seconds that we have available to look at this slide. But I can promise you that if you crunch the numbers, as I have there, the provision of the benefit in kind works out to be 2 quid per month cheaper than if the company were to simply pay a higher salary to Dom. The other thing to point out is that a lot of people watching this will reflexively have gone, hold on a minute, why would you pay salary? Surely you'd be taking a dividend, because dividends are much cheaper, more tax efficient, and that would be an obvious win. Then we wouldn't want to get bogged down in benefits in kind. Well, actually, if again you crunch the numbers, to provide Dom with salary costs the company 196 quid before corporation tax. If the company wanted to provide Dom with enough money after income tax, a dividend big enough so that he had 100 quid after personal tax to pay every month, they would actually have to generate profits, or they would lose or spend profits of £201.56. So in other words, it's actually a little bit more expensive to pay dividends as opposed to salary. And I want to sort of finally give a shout out. No, I don't. I want to talk about salary sacrifice. Sorry, I'm reading the wrong slide. I did say that I would give you a warning about salary sacrifice, or what HMRC now calls optional remuneration arrangement from 2017. And this is where the employer offers a benefit in kind or cash salary, increased salary as an alternative. When you do that, HMRC always wins, because it's now entitled to the tax and NIC due on whatever is the higher amount, whether it's the taxable benefit or the cash alternative. Now, once you know that, bearing in mind that shareholder directors of OMBs basically drive their own remuneration, this can be distilled into a fairly simple choice. Do say, would you like a mobile phone? Because that's a tax-free benefit, as everybody knows, and everybody wins. Don't say, do you want a mobile phone or a £1,000 pay rise? Because now it's salary sacrifice and HMRC gets to tax what would have been a tax-free benefit. Now, there are some benefits which are in the legislation explicitly excluded from this salary sacrifice optional remuneration regime: pensions, childcare vouchers, bicycles, and some cars. But just don't get caught out by it. Now I want to give a shout out to loan accounts. They were covered extensively in the March seminar, which I know you all saw. I just want to convey here that if we have already seen that a salary of £100,000, if you wanted to give a director shareholder 100 grand out of your company, it would be very, very expensive to do so, either in terms of corporation tax on profits then used to pay out a dividend, or in terms of national insurance, etc., employers and IC on top. If you actually, again, work through the numbers, a company can advance a loan to an employee, including a direct shareholder, of 100 grand. And it's currently a 2% deemed interest charge. So this is an interest-free loan, and HMRC says, oh no, you should have charged interest on this. And if you don't charge interest, then we're going to treat it as a taxable cheap loan. And assuming that the loan isn't otherwise qualifying, the benefit in kind for the entirety of 2021-22 is £2,000. Now that might sound like a fair sum, but remember, the only thing that happens then is that the individual suffers income tax on that. So that £2,000 is a high rate taxpayer. Let's say it's Dom again. The actual tax cost for the provision of a £100,000 loan is £800, 800 quid for the year. That is an annual charge, to be fair. And the thing you must bear in mind is that it must be a real loan, by implication, ultimately repayable. Although in some circumstances it can be forgiven, written off, or paid off by a dividend. There is a sort of relatively small, really quite small employers and IC charge to that to the provision of the loan as well, but it's nugatory. The thing to bear in mind with loans, again covered in some detail in I think March, is this idea that if you leave them outstanding for too long, then you do also have to pay a deposit to HMRC of 32.5% of the value of the loan, park it with HMRC, and then when the loan is repaid or written off settled, otherwise settled, then you get that money back. But obviously, if you don't have the funds to be able to pay this sort of 32.5% deposit, then it can be problematic and you will need to call that loan back in eventually. Okay, so putting your family to work. This is pretty basic stuff. Just to put some numbers on this, let's say we're a one-man band company, and he draws a salary or she draws a salary of 100k. It's a single director shareholder taking a salary of £100,000 is going to end up. She's going to end up with £66,500 out of the 100. However, if you had husband and wife, two civil partners, or mother and son, then and you draw £50,000 each, then you get the best part of 10k extra between the two of you. The company is also slightly better off as well because it's paying less employers than I see in the background. Those figures assume no other income, can be flexed as appropriate. You must be able to show that salary is commensurate with the work done. Now, this is relevant, not necessarily for sort of majority director shareholders, but if you're paying a spouse of a partner or child 50 grand for doing 10 hours worth of the admin work in the office a week, then HMRC is going to suggest politely that some of that money is really yours as the sort of controlling shareholder director. And do be careful with children who are under the age of 16. You don't want to fall foul of the child labour laws. So, if it's ideally done with adult children. There's no reason why you would need to sit with salary. You could make pension contributions again, like we already discussed. And likewise, if they're shareholders, would be prepared to give them shares as well, subject to any CGT implications thereof. Then you could do a mix, dividends, benefits, etc., etc. Of course, there is a risk if you put shares into the hands of other people that your company ownership or control is diluted. Okay. Long-term planning, just to give you a sense of what we might look at if we're taking the long view. Cashing out. Now, if you're a trading company, your shares usually qualify for 10% entrepreneurs relief. We're sort of legally obliged to refer to it as business asset disposal relief, but just between us, we're going to carry on calling it entrepreneurs relief because that's how everybody thinks of it. 10% CGT charge on the first £1 million now of capital gain. So it's still very tax efficient, although it has kind of been cut off at the knees. It used to be worth 10 million. Otherwise, 20% for CGT. We're not talking about residential property here. We're talking about shares. So for now, at least, the maximum charge or CGT cost is going to be 20%. Compare that with dividends at 38.1%. So, it's a very, if you can get it, then entrepreneurs relief or even CGT treatment is much more tax efficient than the alternative, generally speaking. For distributions, sort of post cessation, if you're looking at the sort of death at the end of the company, then if the distributions are post cessation are more than 25 grand for everybody in aggregate, then you really should be looking at appointing a liquidator because of the way the law works. Once a liquidator has been appointed, it is generally speaking fixes it as a capital distribution rather than a dividend on which the 38.1% would be chargeable instead. If you're selling the shares instead of winding the company up and dissolving it, selling the shares to a third party is okay. You're looking at entrepreneurs relief ideally for a trading company. There is a mechanism for selling shares back to your own company. But if you're the only shareholder, you're going to go from, I don't know, maybe you've got 100 shares and you own all of them. Then you're going to go from owning 100 shares in a 100-share company to 50 shares in a 50-share company. And that means you still own 100% of the shares. So you're highly unlikely to get capital gains tax and entrepreneurs relief treatment in those kind of scenarios. Doesn't mean it's impossible if the shareholding is spread amongst other family members. The other thing to watch out for when you're selling shares, sort of cashing out, if you will, is if you're not retiring properly, and you may sort of go back into owning and running a similar company within a sort of 2-year time frame, then what you thought was capital gains subject to entrepreneur's relief may retrospectively be turned into a dividend distribution, the forms for better description. I did say that this idea of taking a capital distribution was usually better, but there is another alternative, which is to use your company as a money box, which is a phrase that HMRC loathes, as kind of pension. So say you can't sell your company, but it's profitable, or you don't want to sell. And let's say you don't need all the income that the company generates all the time. So you allow some of the profits not to be distributed as either as salary benefits or dividends. And over the years, you amass a fairly substantial pot. When you decide to retire, then you liquidate the assets that are left in the company, and then you can say withdraw £15,000 per annum. That's just a number I picked off the top of my head. Of dividends on top. A dividend's not a capital distribution, and you add that to, let's say again, £15,000 of state and private pension. Now, £15,000 a year over many years, in today's tax rates, that's going to cost £975 worth of income tax, and that's it. There's going to be negligible corporation tax because the company, once it's ceased to trade, will only be generating interest income, I mean, if it's lucky, on any of the funds on deposit. Now, there may be capital gains within the company when it liquidates any assets that it owns. The other thing to bear in mind is that if there are other shareholders party to all this, then they may well want their slice of dividends as well. So it becomes more complicated unless your other shareholders also want to retire at or around the same time. And it does assume that dividends will remain taxable quite lightly below the higher rate threshold. Now, I mean, the high rate threshold is a pretty substantial amount now, £50,000 plus in the current tax year, but there's no guarantee that the dividend tax rate is going to stay at 7.5% like it is today. Finally, well, for long-term planning anyway, I just want to sort of throw out this idea of employee ownership trusts. Again, if you don't want to sell, or you can't sell to strangers, and this is really for a business that is substantial enough that it has employees who will want to carry on the business after you want to cash out. This is the sort of John Lewis partnership paradigm. You sell to the employee ownership trust for full market value, and it is capital gains tax free, which is brilliant. The trustees will hold a controlling stake in the company from that point onwards for the benefit of the remaining employees. And this obviously, as it in theory at least does with the John Lewis partnership, should drive employee engagement, and they can also participate in up to £3,600 worth each per annum of tax-free bonuses. But the company's got to carry on trading. There are various other sort of markers to hit. The important thing to bear in mind is it's no longer your company or even your family's company by and large. The original shareholders and family will have a significantly, or must have a significantly curtailed interest, and certainly not a controlling interest going forwards. It must be a genuinely sort of, broadly speaking, third party, other employee owned business from that point onwards. So what have we learned? Don't try and fit 40 slides into an hour. 2023's reverse of the last decade's corporate tax policy means that companies will be more expensive tax-wise. Very profitable businesses and all those with several shareholder directors, which serve really to squeeze that safe haven of the first 50,000, may well be better off either staying unincorporated or disincorporating. The new rules from 2023 revive the associated companies regime, marginal rates, tax. It's great for doddering old tax advisors. I don't know. The salary versus dividend question becomes more complicated. Don't assume that dividends are going to be cheaper than salary anymore, or from 2023. Depending on the individual director shareholders' marginal rate of tax and where the company sits, certainly if it's making more than £50,000 worth of profits, it may be that the salary is the cheaper alternative overall. And let's not forget, there are many benefits in kind that have a favourable tax treatment. It's not always about the cash. There are lots of benefits that you can benefit from, but there are a lot of little traps as well. And of course, the report goes into quite a bit more detail on that. I'm going to very quickly look at some Q&As that we've had. I'm not going to spend very long on this at all. Question 1, Derek. When you wind the company up after many years of trading, how do the remaining company assets get taxed? Equipment, money in the bank, etc., etc. What company tax needs to be paid and what personal tax needs to be paid? Now, we did look at this briefly in terms of sort of cashing out. And it really does depend on how you end the company. If you liquidate all the company assets into cash, the company may have corporation tax to pay on any capital gains on those assets. Not all, you really need to be looking at property, maybe goodwill, maybe. It's generally unlikely in that scenario. You could then extract the funds as a capital distribution subject to CGT at either 10% if you've got entrepreneurs relief, stroke business asset disposal relief, or 20% if not. Or you could try or consider certainly the notion of a money box company, which is just now sitting on a pile of cash in a bank account and taking a chunk of dividends every year, sort of reasonably tax efficiently. Or you could just sell the shares. Don't worry about what's going on in the company, just sell the shares. And then the assets in the company are untouched. It doesn't change, it doesn't care. There are other scenarios as well. You could have dividend distribution, specie, etc., etc. Crystal, I am a landlord with 5 single let properties. Recently, I was surprised at the big increase in taxes that I now have to pay, which is compounded by the advanced tax payments that HMRC is demanding. Is it worth exploring transferring the properties into a limited company? And how would I take the money out of my day-to-day living expenses? Crystal, I am surprised that you're surprised, because this has been going on for years now. Yes, it absolutely is worth considering the incorporation of your property portfolio. The real question here is how much or to what extent the mortgage interest relief is hurting you now, assuming that we are talking about 5 residential properties. I mean, if you're mortgage free, there would have to be some other very good reasons, and there are some occasionally, for incorporating a sort of mortgage free residential property portfolio. If you did sort of take the leap and incorporate the business, then it's up to you. Salary, dividends, both. The company could also pay some of your living expenses, like the mobile phone, maybe a relevant life insurance policy, etc., etc. Alison, should you take money out of your business? Should how you take money out of your business differ as you approach a time when you might be looking to sell it? E.g., should you take less as salary to increase EBITDA, or would adjusting EBITDA by owner's salary be considered the norm when selling? Now, this isn't really a tax question. I don't profess any real expertise in share valuation, but to my understanding, most small business valuations will intentionally write back the principal's remuneration package to get the underlying amount that is available for the new buyer. Or occasionally they will do that and then factor in the anticipated salary for a professional manager to run it on their behalf if it's kind of an arm's length scenario. EBITDA, earnings before interest, tax, depreciation, and amortization. Anon, question. Which you knew, obviously. A company, okay, yeah. So Anon has I think it might be clients with 2 directors, one of whom has a very modest company car, and the other of whom has a £300,000 company car, and everything else is 50-50. but there is this disparity in the benefit in kind. And On is asking, well, you know, what should I do here? And the first thing I would say is ditch the cars, because company cars these days, except for maybe the ultra low emissions vehicles, which are really low now to qualify, company cars are almost always a bad idea and almost always inefficient. And a £300,000 company car is almost certainly going to be really, really tax inefficient. I mean, obviously, you know, you might just want a £300,000 company car. It's your choice, or his choice, or her choice. So anything is possible mathematically. Really, what you're looking to determine is, what do you want to equalize? Do you want to equalize the company's cost? Do you want to equalize the company's cost after corporation tax? Do you want to equalize the monetary value of those benefits? And you could do any of those things with the right modeling, but really the underlying question is that going to keep both principals in the business happy?